Canada's housing market is going through one of the largest bubbles in the history of real estate, and the endgame is now on the horizon. For years now, Canada has been in the midst of a real estate frenzy. House prices have jumped 375% in the past 2 decades, and Canadians are now dealing with housing that is among the least affordable in the entire world. In a recent survey, the city of Vancouver was ranked the 3rd least affordable city in the world, while Toronto ranked as the 10th least affordable city in the world. Relative to people's incomes, these cities are now less affordable than New York or London. For a country with so much space and so few people, that is a mind-boggling reality. But now signs are pointing to something truly ugly. This 2-decade-long bubble is about to burst. Mortgage rates have been rising for the past year and a half, putting home buying out of the reach of most Canadians. Sales have plummeted. Developers are pulling back on new construction, and investors are selling. All the ingredients are needed for a housing market crash are now in place. So what drove house prices up in Canada to such insane heights, and why is this long-running bubble starting to collapse now? In this video, we'll answer these questions, but before we do, be sure to subscribe to our channel for notifications on all our latest news and analysis. And if you like this video, hit the like button and help us spread the word. Canada's current housing bubble began at about the same time that the US's last housing bubble collapsed. During the great financial crisis that began 15 years ago, the US saw house prices collapse, causing a massive knock-on effect on its financial system. To combat the problem, the US Federal Reserve dropped interest rates to rock-bottom levels. The Bank of Canada, the country's central bank, quickly followed and dropped its own interest rates to rock bottom. But Canada at that time didn't have a financial crisis. Its banks were running smoothly, and its economy was stable. It's questionable whether Canada needed to drop its interest rates to such low levels, but regardless, it happened, and mortgage rates fell to their lowest levels ever. That gave Canadian homebuyers a massive amount of buying power. The lower the mortgage rate, the less interest you have to pay on your mortgage, which means that as mortgage rates drop, you can afford to buy a more expensive house. Canadians suddenly could afford to spend far more on a house, and not so surprisingly, house prices began to rise. In essence, the Bank of Canada juiced the wrong housing market, triggering a massive bubble that just kept on inflating for year after year. Other things were happening in the housing market as well. Canada's major cities, especially Toronto and Vancouver, became popular among foreign homebuyers looking to invest their money outside of their home countries. Wealthy investors from all over Asia, especially China, began buying up homes and condos across Canada. They would often buy these properties sight unseen, and they certainly wouldn't bother to live in these homes or even rent them out. The idea was to park their cash somewhere where the Chinese government couldn't get its hands on it. Canadian real estate also became popular with criminals looking to launder their cash. Canada has some of the weakest regulations surrounding real estate ownership of any developed country. In most parts of the country, you can buy a home under a numbered corporation and don't even have to reveal who owns that corporation. Banks are supposed to flag suspiciously large cash transfers that are used to buy homes, but they just turned a blind eye to the problem. Everyone was making too much money on real estate to care about where the money was coming from. But it wasn't all foreign buyers and organized crime driving up house prices. Domestic investors jumped in on the action too. As house price growth accelerated, real estate started to give better returns than other investments like stocks and bonds. So Canadians pulled their money out of their investment accounts and purchased second and third homes with the money, renting the properties out. And so house prices accelerated even more. And that was the situation when the COVID-19 pandemic hit. As Canada's economy froze up due to lockdowns and business shutdowns, the Bank of Canada once again dropped interest rates to rock-bottom levels. But this time it did something else too. It started buying mortgages off of the books of mortgage lenders. It bought those mortgages with freshly printed cash. Armed with this cash, mortgage lenders offered new mortgages at rock-bottom rates. In 2020 and 2021, it was possible to get a mortgage in Canada with a rate of less than 1%. All this juiced the housing market to extreme levels. In the space of a few years during the pandemic, many cities in Canada saw house prices grow by 50% or more. But behind all the financial manipulation of the market, the exploitation by speculators and organized crime, and the buying out of the housing supply by investors, another major problem was building: a shortage of homes. It's hard to imagine a country as spacious as Canada running out of room to house people, but that's exactly what has happened. Canada has the lowest supply of housing relative to population of any G7 country. For Canada to have the average amount of homes seen in countries like the US and Britain, it would have to build 1.8 million homes, an enormous quantity for a country of 40 million people. This problem has been decades in the making. For generations, Canada was one of the most affordable countries in the entire developed world. Despite rapid population growth from high levels of immigration, house prices stayed stable for generation after generation. There were ups and downs here and there, but for the most part, housing was affordable. Canada is a vast country with enormous amounts of space, and its cities could always grow to meet demand. On top of that, the country's federal and provincial governments were deeply involved in the housing market, subsidizing apartments for low-income families and making it easy for developers to build homes for the middle class. Canada has a government-run mortgage insurance company called the Canada Mortgage and Housing Corporation. In the decades after World War II, CMHC guaranteed loans to housing developers, and it even had a catalog of pre-approved home designs that developers could build quickly. Canadian cities had loose regulations on development, allowing developers to build housing wherever it was needed. But over time, all of this changed. In the 1990s, Canada's federal government struggled with a massive debt crisis. It cut back on housing subsidies, and basically from that point on, Canada stopped building housing for low-income families. Meanwhile, Canadian municipal governments began treating housing like a cash cow. Year after year, decade after decade, they raised the development charges on new homes. That is, the taxes they charge to developers for building new homes. In Toronto today, a new single-family home comes with a developer fee of $137,000. There are places in North America where you can buy a whole house for that money, but in Toronto, that's just what they charge in taxes on a new home. There's an old saying among economists, if you tax something, you get less of it. As developer fees have gone up, new housing builds have gone down. But that's not all. Canada's cities have been changing how they allow development to happen. In recent years, they began to put restrictions on urban sprawl, limiting the ability to build new homes on the edges of cities. Today, there is an urban containment boundary around Vancouver which protects the farmland surrounding the city from being converted into housing. The Toronto metro area has a green belt surrounding it, which protects the wilderness and farms around the city. But it also severely restricts where housing can be built, and the space within the green belt is running out. So developers have shifted to building in existing neighborhoods. But here too, there is a problem. Residents of existing neighborhoods don't like infill development that brings apartment buildings to their neighborhoods of single-family homes. City councilors tend to side with those residents, so infill development is very hard to pull off. Instead, developers have focused on building on old industrial land, such as warehouse districts and unused rail yards. But these neighborhoods tend to only be good for building high-rise apartments and not single-family homes. Over the past decade, the construction of single-family homes has dropped off a cliff in Canada's major cities. In Toronto, there are barely any single-family homes still being built. The problem is people still want to live in these homes. For generations, Canada has been a place where children grew up in a house where they could play in the backyard. As construction of new detached homes has slipped, prices have skyrocketed. Today, the average price of a detached home in Greater Vancouver is 2 million Canadian dollars, or about 1.5 million US dollars. In Greater Toronto, a single-family home averages 1.8 million Canadian dollars, or about 1.3 million US dollars. For the families that bought homes a generation ago when they cost a few $100,000, this has been a huge windfall. But for those trying to break into the housing market, it's a disaster. And that disaster has been made worse by rising mortgage rates. All that money printing that the Bank of Canada did during the pandemic had its inevitable effect. It started to cause inflation. To fight that inflation, the Bank of Canada began raising interest rates in early 2022, and it hasn't stopped. The rate on a mortgage in Canada went from as low as 1% in 2021 to around 6% today. In other words, interest owed on mortgages has grown six-fold in less than 2 years. And that's going to catch up with every single Canadian mortgage borrower because, unlike in the US, mortgages in Canada don't last 30 years. In Canada, mortgages typically last 3 to 5 years and then have to be renewed at a new interest rate. You can also choose between a fixed rate for that 5 years or a variable rate that goes up and down with interest rates in the economy. During the pandemic, variable rate mortgages had lower interest rates than fixed rate mortgages. With house prices so high, many buyers chose the variable rate. About a third of Canadians today have variable rate mortgages where the interest rate can go up and down every month. When the Bank of Canada started raising rates, 1/3 of Canadian mortgages instantly started to get more expensive. Plus, the remaining fixed-rate mortgages all come due within 5 years, meaning even people with fixed-rate mortgages are now being forced to refinance with much higher interest rates. This is putting the financial squeeze on Canadian households. Families are draining their savings to survive. Wanting to avoid a US-style housing bust, Canada's banks came up with a novel solution. They started increasing the amortization length of mortgages, that is, the amount of time it takes to pay off a mortgage. This lowered mortgage payers' monthly payments, but it also extended the length of those mortgages by a lot. lot. Because the amount of money being borrowed is so high, many Canadians now have mortgages that will take 70, 80, or even 90 years to pay off. In other words, many Canadian homeowners have discovered that they will never actually own their home. They are debt slaves. But now Canada's banking regulator, OSFI, is working to block these insanely long new mortgages. While that may help keep Canadians out of debt slavery, it will also mean extremely unaffordable monthly mortgage payments. And something else is happening. On the other side of the Pacific Ocean, a major housing bust is playing out in China. The country's two largest developers, Evergrande and Country Garden, have defaulted on their loans. To prop up the Chinese yuan, the government has banned government elites from owning overseas real estate. This means that many Chinese buyers in Canada will soon be selling off the properties they bought over the past few decades. A major driver of Canadian house prices is about to dry up. To put it simply, Canada's housing market is reaching its mathematical limits. There is nowhere to go but down. And in fact, Canada's massive house price juggernaut ended a year and a half ago when interest rates started rising. House prices fell by 18% in 2022 despite massive new demand from record high levels of immigration. In 2023, when the Bank of Canada paused its interest rate hikes, prices started rising again, but they never regained the peak seen in 2022. In other words, the recent rebound in prices is a dead cat bounce, a temporary increase along the way to a full-on crash. Since the start of 2023, Canada's house price index has fallen by 10.1%. That's a rapid decline for half a year, and when investors realize their properties are no longer growing in value, we can expect to see a massive investor exodus from the market. That's when the full-on crash will begin. If you own a home in Canada, hold on to your hat. It's going to be a wild ride. If you like this video, hit the like button and help us spread the word. And don't forget to subscribe to get notifications on our latest news and analysis. In the meantime, check out one of these videos here to learn more. Thanks for watching.